Trying something new with 3 Stock Lunch today. 3 key stock stories on our radar, and our team of reporters will give us the news and moves. Then our trader, Courtney Garcia, the senior wealth advisor at Payne Capital Market and a CNBC contributor. Then she will give us our trades. Welcome, everybody. So, Christina, let's start with you.
Well, after Palantir's surprise earnings on Monday, I wanted to look into other potential profit anomalies. We screened for high net cash flow as a percentage of total debt, so a high ratio means they can better pay down their debt. No positive quarter of earnings on a GAAP basis because non-GAAP doesn't always accurately portray the operations. Obviously, they have to have a market cap above 500 million. And on top of that list, we've got New Holdings, a digital banking platform. Because of their ability to pay down debt, it's right now trading at, $5? The stock is still 56% off its 52-week high, but Berkshire Hathaway's recent 13F showed they still back that name. Other familiar names topping the list, the potential profit list, cloud company Snowflake. Its earnings are out March 1st. Duolingo is also on that list. And last but not least, you've got CrowdStrike, which, by the way, is trending down 2.5%. It's more than 50% off its 52-week high. But it's on that list, and as we look, the hunt for the next Palantir continues, or at least a great M&A candidate. Kelly?
All right, Courtney, what is the trade for you?
Yeah, I actually would stay on the sidelines of it, the likes of a Snowflake here. And this is a great company, right? But sometimes you have to separate a good company from the stock. And this is a company, they've had good growth, they have good management, had a very receptive platform. But this is one of those hyper growth companies that is not yet profitable. And hopefully they do turn a profit here. But these are the kind of companies that are going to continue to be under pressure in an inflationary environment. And the way that they're structured is they're under a consumption-based model, meaning the more that you use it, the more you pay. The less you use it, the less you pay, as opposed to a subscription-based model where you pay regardless of your usage. And this can actually be a problem because the revenue can be a lot more erratic, and especially when you have your mid or your small-size companies. We do go into a slowing growth environment, which we very well may be in. It's just really not as reliable. So I think for those reasons, good company, I'd stay on the sidelines with their stock.
All right. Speaking of small fries, Shake Shack reporting earnings before the bell. Pippa Stevens has the details, but only if you promise to share the fries, Pippa.
I can never share fries. Love them too much. But Tyler, a lot of focus here on the guidance, given that Shake Shack released preliminary results back in January. But starting with those fourth quarter numbers, the company posted a smaller than expected loss, with same-store sales rising 5.1% due to a combination of higher menu prices and traffic growth. Now, for the current quarter, Shake Shack raised its revenue and same-store sales guidance, saying comps were up 17% in January. That is, of course, against Omicron numbers. Still, the company said the inflation outlook remains uncertain. While beef prices have fallen, dairy and fries were up sharply, with paper costs also weighing. The company said as of right now, it has no plans to raise prices further. The last price hike was back in October, but that could change. And finally, amid concerns around cutbacks, Shake Shack reiterated that it is over-indexed to higher-income consumers, where the trends, Tyler, are still pretty good.
That sounds pretty good. All right. Thank you very much, Pippa. Courtney, what's your take on Shake Shack? Is it a shake or a bake?
I like that question. Also, I would avoid Shake Shack here. I do love a good Shake Shack burger, don't get me wrong. But their biggest problem right now is inflation. And actually, you just noted a lot of the issues that they've had where they are actually operating at a loss right now. And they have been affected by higher labor costs, higher inflationary costs to create a burger. Also, they've had a lot more delivery costs. But on top of that, they've had to raise their prices, which thus far they do have a higher consumer customer, which hasn't really impacted demand. But at what point, I think, is the question. And actually, there was just a survey that came out by Stifel, which I thought was very interesting. And it looked at a lot of it, this and its competitors. And people just think it's starting to get too expensive. And at what point are you stopping and to go to a Shake Shack if it's going to get comparable to the price of a restaurant? And I just think at a certain point, if you don't have that sort of pricing power you want in this environment, it's not the kind of company you want, especially if they're operating at a loss right now.
All right, let's get on to our last name then. Paramount reporting results. Julia Borson has more. Julia, stock well off the lows.
Stock is off the lows, but here's what happened here, Kelly. So Paramount Plus showed user strength and grew its users faster than expected, but the costs associated with Paramount Plus and macro challenges resulted in a miss on both the top and bottom lines. That sent the stock falling. It's now down about 3%. Now, that shortfall, especially in revenue, was driven by a 5% decline in quarterly ad revenue. That outweighed the fact that Paramount Plus added 2 million more subscribers than anticipated, adding nearly 10 million in the quarter. The company says that streaming operating losses, which widened in the fourth quarter, would peak in 2023. And CEO Bob Bakish announced that they will raise prices for their streaming services. He also said that the combination of Showtime and Paramount Plus should generate some efficiencies and also minimize user churn. Bakish also painted a picture of an improving ad market. He predicted a rebound in the ad market in the second half of this year, and he noted that certain areas, including food and beverage, pharma, and increasingly auto, are seeing strength right now, Kelly. So some insight into the consumer, perhaps.
True, although you should be wearing a Stetson hat for Yellowstone there. Courtney, what's your take? Let's get your final take on Paramount.
Yes, actually, I would be a buyer of Paramount here. They did disappoint on their earnings, and you're seeing them down today on that information. But when you actually look at it, it's pretty mixed. So obviously, advertising was a problem for them when you look back at 2022, because advertisers were pulling back in the midst of a slowing growth environment. But they're starting to see a light at the end of the tunnel there. And their costs are higher there, which really Wall Street does not want to see. But they were late to the streaming game, right? So they only started Paramount Plus about 2 years ago. So I think in those first few years, having higher costs is almost to be expected. And the fact that they're still bringing in so many subscribers, they had 9.9 million subscribers this last quarter, I find is very impressive. And they also are expecting those costs to be peaking this year and coming back down next year. So I think longer term, this actually still has a really good story here. That's not to mention it pays a 4% dividend, which I think is definitely worth a look.
All right, Courtney, thanks so much. We appreciate it today. Courtney Garcia, the glasses are empty.